All right, thanks for sticking with me. Just going to go into the emerging markets and kind of relate that to the base case for the increase in oil prices and how that's probably going to translate into capital coming out of some of the larger advanced economies where interest rates are going to be substantially, possibly lower. And it may lead to capital flowing out to chase interest rate differentials and growth differentials in some of these emerging markets. The other thing with oil and commodity prices in general are likely to get a boost after the Saudis do what I think is going to be a surprise production cut in April of 2019. So the 1.2 million barrels a day is obviously not enough to offset the strength in production in the U.S. shale. So ultimately, some of these foreign capital flooding out of these markets, chasing interest rate and growth differentials, are very likely going to happen in probably the end of Q2. Some of them are already taking place as of now. The dollar weakness is going to be the main driver. So as the dollar weakens through Q3, Q4, and into Q1 2020, as well as most likely into Q2 2020, based on my base case scenario, we're probably likely to see countries like Vietnam, the Philippines, Indonesia, Malaysia, and Brazil reap some of the benefits. And the other thing tied to that is that my base case scenario is that the Fed's going to raise rates 25 basis points and get the federal funds rate up to 275 basis points in May. However, if they were not to do that and they chose to basically follow the market, which is basically to remain as accommodative as possible and not hike rates, and if global inflation were to remain relatively tame and close to inflation expectations remain anchored and near target, you're going to see a wave of capital most likely going into the emerging markets into Q2 and into Q3. And some of that's just going to be driven by the fact that Brazil is looking at between 19% to 22% earnings growth, which puts their earnings yield at about 7.94. The Philippines earnings yield is about 5.7. Indonesia is about 6.96. Malaysia's at 5.18. Vietnam's at a healthy 7.04%. And the market returns in 2019 in Brazil are likely going to be 20.52%. The Philippines are looking at about 14%. Indonesia's looking at about 14%. Malaysia's looking at 7.4%. And Vietnam's at about 17%. So the earnings per share growth for each of these countries in 2019 is expected to be average about 12.86%. Dividend yield is going to be probably about 1.72% in 2019, and the market return in total for these particular countries is going to be 14.58%, and they still have a staggering low PE, so the earnings yield is going to be about 6.8% for all these countries in combination. And now, if you think about where I said the U.S. market was going to be, where the equity market was going to be in the U.S., I'm targeting a base case scenario says about 3% growth in earnings per share for 2019, which we're basically looking at a $166.86 for the S&P earnings per share. I'm saying that the ending values are going to be between 2,336 and 3,000. So the U.S. market is sort of kind of looking rich in comparison to the emerging market. So the U.S. earnings yield at this point is about 5.75%. So you can see the capital, if there is dollar weakness in the toward the end of the second quarter into the third quarter because of the deceleration in the U.S. economy and GDP, that capital is definitely going to make its way into the emerging markets in both the equity market and as well as the local currency bonds, which again have staggering differentials with advanced economies. So some of the things that people don't tend to think about in the market are some of the geopolitical issues. So, and I just want to kind of touch on some of those fairly quickly here. So some of the geopolitical issues that the market usually fails to understand and act upon, and I think some of the biggest ones, and this is just again my personal opinion for 2019 and into 2020, geopolitical issues. The number one issue facing the globe is definitely populism. And that's a global issue from the U.S., Europe, Middle East, and South America. The other big issue that doesn't get a lot of press is the U.S.'s ability to use its freedom of navigation in the South China Seas. At some point, I'm not going to go into a lot of detail here, but at some point there's likely going to be a disaster, or there you can kind of sense that tensions are rising, and there's possibly a disaster that could be in the middle of the U.S.'s ability to navigate effectively through that. And then you throw in some of the Taiwan issues, and you could see there's a pretty much a disaster getting ready to brew there. The other thing is too the U.S. freedom of navigation in major commercial trade and crude shipping routes. As China is now the largest importer of crude oil, and India, they're obviously going to want to have some naval authority to navigate through those trade routes and those commercial, those crude shipping routes, and also those potential commercial trade routes as they expand their One Belt One Road initiative, or BRI, Belt Road Initiative. They've also put a military base in the country Djibouti, which is in a strategic crude oil choke point. So there's also the freedom of navigation. I guess the other thing I want to add with the U.S. freedom of navigation is the Arctic is ultimately in 2020 and 2021 and 2022 and 2023 due to climate change. It's going to be a game changer in terms of how shipping routes and commercial trading routes through the sea are going to be used and utilized. Again, not going to go into detail on that. Just say that the Arctic is ultimately going to be a game changer, and it's going to have to, and the U.S. is going to have to be able to effectively use its freedom of navigation to navigate through the Arctic. The other thing is that there's a possibility of Korean unification between both North Korea and South Korea. That could potentially change or harm U.S. military interest in the region. They're also, and again, that has a direct effect on the U.S. freedom of navigation in the South China Seas. If the two of those Koreas were to get together and decide that they didn't need the U.S. and they didn't need the U.S. presence in there anymore, the benefit probably would go directly to China in terms of allowing them to expand their sphere of influence in that region. The other thing is that there's LNG gas pipeline infrastructure from Russia into Eastern Europe. That didn't get a lot of attention, but there's a pipeline that could avoid Russian gas being piped into Ukraine, and actually would go around and directly into Germany. The administration pushed back on the pipeline, but it at some point is going to be finished, and it ultimately affects the relationship with the U.S. and its allies in the sense that we're going to be pushing a lot of liquefied natural gas, and we'd like to find a home in our European allies as quickly as possible, and sort of kind of reduce their dependence on gas from Russia. Also, soldiers leaving Syria, that's going to obviously create a vacuum that will need to be filled, and it could be filled by Iran, Russia, or Turkey. The vacuum filling in the Middle East could prompt conflict between Israel and Iran, which would ultimately bring the U.S. into conflict. Also, there's the trade war and the currency readjustment that needs to take place in terms of global rebalancing, which could create supply side difficulties, leading to populism in countries where populism doesn't currently exist. And then, the final thing is that this just miscalculations in this new game of risk could create situations similar to 1971. So if you think about 1971, that was sort of kind of the end and decline of the British imperial empire. And they moved out of the Middle East and a lot of different places, and that created a lot of additional problems that were ultimately, the U.S. ultimately filled the vacuum in a lot of those areas. So those are some of the things that the market should probably think about going forward, because it could have a shock to global markets at some point if any of these things were to really go terribly awry. And I guess the next topic that's going to be covered is going to be the U.S. twin deficit, and kind of detail where the 10-year Treasury is going to be, and if the market's going to be able to absorb the Treasury issuance, which is going to be substantial over the next 2 years, because we're going to be running a $1 trillion deficit in this year, as well as a $1.1 to $1.3 trillion deficit in 2020. And so the Federal Reserve in both of those years is obviously running down its balance sheet. So mortgage-backed security runoff and also Treasury runoff is going to play into yields. So a lot of the theory is that if you're running a twin deficit and you have to rely on foreign savings, which the U.S. will continue to have to rely on foreign savings, that foreigners may decide that they don't want to do that at the prices that are at the yields that U.S. Treasuries are currently at, and that there could be people that want to push those yields higher, given the fact that inflation is likely to still remain relatively benign, even given the base case scenario that I have for oil prices and the salty production cut happening in the second quarter in April. Inflation expectations aren't going to drastically jump, and even with the tight labor market, we're not likely to see that put significant and additional pressure, especially with dollar strength during the first quarter and the second quarter. But it could be a fact. It could play into inflation expectations later in the third quarter and fourth quarter as the dollar depreciates in value, because it has to adjust to what's taking place in the global economy. So those are just some things that I'll go into. And so if you like this and you want to stick around for the next video, that will be out at some point shortly.